Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to talk about where we are in the cycle, some differences between this cycle that we're in right now versus maybe other yield curve uninversions. Why does it matter? We'll talk about why going through this cycle, why it matters. We'll go through the quadrants together. And so we'll have quadrants, the 2 and 10 year, and kind of how some of these assets performed during the cycles. So let's dive in. I'll give you my financial opinion. If you guys like this type of analysis, check out finding-value.com. You can ask me directly questions about where I would be positioning during the yield curve inversion like this. What are some of the investments that I have? You can see my portfolio on the website. You can see when I'm buying particular companies, etc. We do have a discount going on, spooky. This is going to be the last day that it's available, which is October 31st. And there's some pretty good discounts there if you look in the description link. All right, let's dive in and let you guys know what's going on here. So I've got the U.S. 2-year divided by the U.S. 10-year yields. So when people talk about yield curve inversion, they talk about, let me get my little brush up here. They talk about this going upward like that. When it uninverts, it's when it comes back down. So those are uninversions. Generally, when this goes down, we generally get a crash somewhere in this region in these cycles. We get a crash. And it's like the market can see the crash before it occurs. How does that happen? Why does the yield curve uninvert like this? Well, I can give you my opinions on it. The opinions that I have is that the banks know good and bad collateral, good and bad debt. If they see that on their books, there's a lot of bad debt, and that there's a potential crash that could occur. What they generally do is they go and they buy a bunch of bonds. And when they buy a bunch of bonds, that generally pushes the 2-year back down. It pushes the whole yield curve back down. So you'll see the 2-year, the 10-year, the 30-year, it'll all start to come back down. And what that means is that when yields go down, it means that there's more buying pressure in bonds. And people generally load up into bonds when there's a problem in the market. So let's go to the quadrant real quick and understand the quadrant before diving through all of this stuff. Let me do something here real quick so you guys can, I just want to make sure you can see it all. So looking at the quadrant, this is the quadrant. What this is when the yield curve goes up and down, these are the quadrants you want to be in. So when the yield curve comes out of the bottom there and starts to come back up, you get acceleration of growth with very slow inflation. So this is the recovery phase is what I like to call it. This is where recovery phase is. As inflation increases due to the loaning in the system, generally it's driven by the real estate market. That's what drives all this. We go to an expansion phase, and then we go into this phase over here. This is the expansion phase. In that phase, you want inflation-protected bonds, emerging bond spreads, gold commodities, international real estate, and emerging equities. Eventually, what will happen is interest rates will go up, and you get a slowing of growth. So your inflation is still out there, but you start to slow down your growth. This here is your hypersupply phase. Things are starting to slow down, but they haven't screeched to a halt. So that's gold and commodities. You can see they're in both of these, emerging bond spreads and inflation-protected bonds and cash. Once things start to fall apart, they overbuild. You get a deleveraging event in the market. Something happens in the market. You can see a slowing of inflation and slowing of growth, which is called a recession. That is where you want long duration treasuries and gold to be basically piled into those. And that's where you can see, based off of knowing what assets are in here, you can kind of tell and gauge where you are in the cycle based off of the performance of these assets. Now, I'm sure someone's going to say, where do you think we are located? I think that we are located somewhere in this area over here. One of these areas here. We're not down here, at least not yet. A lot of people think that we're going to get a recession, which means that we would be over here. I am not yet convinced. We've got let's say a 4% GDP number. That's accelerating growth. That's not slowing growth, but that's on a nominal term. It's not on a real term. We could be slowing real, but are growing on nominal, which is still going to be inflationary. So we're in one of these camps up at the top. That's debatable. We're up here somewhere. We're definitely not down here. We have not already had the recession, and it's already behind us. So the real estate cycle is what drives this. That is the business cycle. The real estate cycle is the business cycle. And we are in a expansionary phase of real estate right towards the average at the moment. If it falls, we could go into slowing growth, slowing inflation. And there's data that we can look at to validate that. So going back to the charts, the cycle is represented by the 2 and 10 year, this yield curve. Not the curve, but the inversion and uninversion of the curve. So as we have more inflation, we come on up. As we have more inflation, we come on up, and the yield curve inverts. That puts us in that upper right-hand quadrant. As we stay up here, that puts us more towards the left-hand quadrant, but it depends on what this is doing. And I'll show you what I mean by what this is doing, what the 2 year and the 10 year are doing. I'll show that here coming up. But generally speaking, it's good to be looking at gold when you're at these peaks and it starts to roll over. Gold in 2000 was a really good bet. Gold in 2007, gold in 2019, and even before 2018, and even gold right where we're at today. Because as this yield curve goes back down, if you notice with the quadrant, gold does really well. So does long duration treasuries. Now, you can go and you can look at these things and say, okay, where are we at in this cycle? Well, the yield curve, someone's going to say it's uninverting and we're going to get a crash. Well, it's possible. It is uninverting and we're right on support here. It's right on top of it, and we'll see if we get a bounce higher or if we go sideways or if we break to the downside. If we break to the downside, that is your yield curve uninverting. Gold's going to go up. And historically, long duration treasuries go up during that condition. So if that condition were to exist today, we should be seeing long duration 10 and 30 year yields start to go down if that was the case. Okay, so we go to the 10-year yield. Is it going down? No, it's not. It's not going down. The momentum's definitely to the upside. I'm looking right now to see if this is a reversal candlestick here, and if we're going to go lower. If we go lower on the 10-year and the 30-year, the 30-year is doing the same thing. It's got this little bearish piercing type pattern where we could turn, but obviously the momentum is definitely to the upside. This is not telling me or screaming to me that a recession is necessarily here yet. So commodities and gold are still, in my opinion, good because we have not seen a decline or a run into the 10-year and 30-year yields. I have not seen that. Even on the 2-year, the 2-year is still remaining quite resilient and it has not fallen yet. But if these do fall, then we know that a slowdown could potentially be coming. So if we were to look at last bull market to see how this behaved last bull market and then bear market, we could see, And I'm going to go back to the last commodity, the commodity markets. I'm just going to put it as a line. So this is the 2-year. We can see that we had a commodity bull market start here. That's where it started. It ended in 2008, which is over here. There's your commodity bull market there. From red line to red line's the bull market for gold. We came on up we inverted the yield curve originally, and then we had some problems in the market. The yield curve came back down, and the 2-year basically crashed. It crashed lower from May of 2000 all the way to the bottom of May of 03. So that was a crash in your 2-year bond yield. We also can go look at the 10-year, and we can see that in 2000, this is your 2000, we had a crash in the 10-year all the way down to April of 03. Then we had a move upward all the way to 2007, and then another crash lower in the 10-year and the 2-year. It was the curve coming back down, signaling that people were running into bonds. That is where you could see that the flight to safety occurred in that time frame. Also, in this time frame, we had a housing market oversupply phase here, and we had everything crash behind it. So that was also seen in slowing of housing starts, increasing inventory levels of real estate, et cetera, et cetera. During this move here, we did not see an increase of inventory, and we did not see a gigantic crash in housing starts. They slowed down, yes, but they did not crash off the page like they did in 07. So the bull market was during an expansionary phase of real estate. We had a puke from basically the NASDAQ puking over and a slowdown in that market. We can also go and we can look at some other data here. Let me increase this open and maximize it. I'm going to go and look at some data for construction. A lot of people talk about the slowdown in unemployment, and a lot of that comes from construction and housing starts and all that stuff. So this is the housing starts. This was the last bull market from 1998 all the way to 2007. There's 2008 down here. Generally, you go from bull market, it goes below the average here. I don't know why I've got that white line down there. Let me move it up here. So the average is somewhere like in here. When it goes below that, that's basically a recession. And bull markets generally do pretty well if it stays above the average. So we had a little dip, and then we ripped it up to the upside when they lowered interest rates. We had a massive overbuild cycle, a big bubble in real estate, and then it turned back over. This is where long duration assets went up. You know, the prices of those went up, the yields went down in this time frame. It was in that time frame. Now, we don't see that. We have a decline in the housing starts because of affordability. We have very low inventory levels. And the commodity bull market signal is the same signal as here, which is the same signal as this commodity bull market here in this big expansionary phase of real estate. We don't have the inventory. So we could get a slowdown, which is possible, like the NASDAQ bubble. The thing is, when I go and I look at the 2-year yields, which is an indicator, are people running into 2-year yields? No. They're not running into 2-year yields, and they're not running into 10-year yields yet either. So we're not seeing the flight to safety. But is that flight to safety being disguised under the amount of bond releases that the government has to release? Is it being disguised because of the supply demand of 10-year and 30-year and 2-year bonds? I don't know. That I do not know. But I can tell you this. The prices, the yields are not dropping. The yields are still high. And I think that we are still early in this bull market. I don't think we built the homes. So if we haven't built the homes, it makes me think that we are closer to this era of like 2000, 2001, where interest rates go up and it cleanses the system from malinvestments. It cleanses the system like the S&P 500 and the NASDAQ from being so overvalued. And when interest rates go up, their net present value calculations are going to be a lot lower. So we could have interest rates go up like they have, get into an inverted yield curve, have the 10-year rocket to the upside like we've gotten. And this should reprice assets. And we haven't seen the big repricing of assets yet. I think we are going to head lower in the pricing of these assets. I think this is probably a double top potentially, and that we see a lowering of the S&P and the NASDAQ. The NASDAQ is this one here. So I think that this is probably a double top. It'll probably break lower, is my guess. And that is due to the increasing of interest rates. When that busts, when that goes lower, what you're probably going to see, is my guess, is that this could go and break to the downside. That we actually cycle back lower to the downside, come all the way back, and then we'll have to cycle back up again. That is a possibility. Very much is a possibility where we have to cycle back down. Now, that doesn't mean that that will be the case. We could also stay up here, which means that he holds interest rates higher for longer. So the 2-year stays held higher. It stays held up here for a long time. That is exactly what Powell has said he's going to do. So if you take him at face value, he's going to hold the interest rate up here for a while. And what that does is he's trying to slow down the real estate market. He's trying to slow down the business cycle and credit creation. So that's what could potentially happen. And what is occurring today, and even though the 2 and 10 is starting to dip, perhaps the long end of the curve is repricing itself, where it's going to move the curve completely upward, which we haven't seen in a very long time. We've been in a 40-year decline in interest rates. So now everything's basically adjusting in the system, and the long end of the curve is starting to come up. When the long end of the curve comes up, that's going to be seen as a decline or an uninversion of the yield curve. But the 2-year isn't necessarily coming back. It's just being held at a higher level. The 2-year is a representation of the Fed funds rate. I mean, that's basically what the Fed funds is the 2-year. And these were the previous cycles. This was held higher for longer there, that's for sure. And that was from 1995 all the way till 2000. That's a 5-year hold of higher interest rates. I mean, they came down a little bit, but it was held high for a pretty long time back here. They held it here from 06 all the way to July 07. It went sideways. A lot of your commodities during this time frame went ballistic. Uranium, oil, all of those things, when they held the higher for longer, they all kind of exploded during that time frame. That could happen right here. We could be held higher for longer. We do not have a crash necessarily, and we go sideways, which means all of our commodity investments, we shouldn't do anything. We should just sit where they're at and let them go. A lot of people are in that camp, and some people are not in that camp. Some think that we are going to get a slowdown and that the rates are going to come back down. I think that we're going to be higher for longer. I'll just take him at his word. I think they'll be higher for longer, and I think the commodities are going to start to run. That's what I think. But just because I think that doesn't mean that's what's actually going to happen. So I think they're going to hold them up there for at least a few years, is my guess. Unless something breaks in the system, then they'll lower it, potentially. And maybe something does break in the system. I don't know. Curious to see how this actually plays out. But that's where we are in the cycle. We're in an increasing interest rate environment, which is generally inflation is slowing, but we still have growth in terms of economic growth according to their GDP numbers, which are nominal numbers. So economic activity is still hot. That puts us, again, I think in this area on the right-hand side with accelerating growth. The growth is still there. And yes, we could slow and it could go back and forth, but that's where I think we're at. Some people think that we're in a different location. So that's what I've got for today, guys. That's what I really wanted to talk about was kind of where we're at. And what I'm using for the movements is the Fed funds rate and the 2-year yield and 10-year yield. That's what I use. Some people use other ones in different durations and stuff. You can also look. I can put gold underneath this. So this is the price of gold. You can see when they started raising rates here, gold it went up during that time frame because gold was already moving. But we can look at some of these when interest rates go down, gold basically sniffs that out beforehand and starts to move higher. So when you're at a level that's very high, gold starts to move to the upside. We're at a level that's very high, gold's going to start to move to the upside. I think gold is probably the least risk asset to hold at this particular time. Because if they do hold for higher for longer, I think gold's going to start to take off. That's my guess. Platinum too, and whatnot. Now we can also look. We can look at those assets and also determine kind of where we're at in the cycle. Platinum. If you look at platinum, 98 was kind of the beginning of the bull market of commodities. Here's 98. It took off. It pulled back. This was 2000, 2001, and then it took off again and really ripped it. I think something similar is occurring there. So if you said, well, 2020 is kind of the bottom, remember 98 was the bottom here. I'm just going to grab this fractal here. So if I take the fractal here and I'm going to overlay it where the beginning of it was, this is what could potentially be occurring here. And it looks something on the lines of there's your big move there. And it doesn't have to be perfect, guys. And maybe this came back down for whatever reason, but that's kind of what it looks like to me. And maybe we go to $4,000 an ounce if this fractal is positioned correctly and big enough. Your consolidation is this 1, 2, 3 consolidation, your 3-hump consolidation. It started going up in 2018. This was the COVID crisis. So your beginning point is actually that point right in 2018, in my opinion. 2018 is where we bottomed, and then COVID was kind of a crisis in that. Perhaps they're trying to hold this thing all down. I don't know. Perhaps it's something like this on the lines of that. I'm just trying to get the bottom to the top to get that first kind of wave. And then this is what potentially comes 3,800, 4,000, something like that is a possibility. Depends on the psychology of the markets. There's other things that could easily blow this to the upside. Easily. But this is just me playing around with the fractal. There's another thing where someone could argue that this was a false move back here because of stimulus. This move here is a stimulus move, and it was an artificial move. So we could even say that this hasn't really started yet, the big move. And that could also be the case as well. Looking at all this stuff, I'm just going to delete some of this that I put on here. So when we can also look platinum. So platinum was a leader. We can also look at the platinum to silver ratio and all those things. Platinum took off first. Silver was behind it. Platinum hasn't taken off yet. Another thing we can look at is KRE, which is the banking sector. Generally, what you see in the banking sector is more loaning. If we went through this big real estate boom, what you'll see is bank loans go up. which generally means that they're going to make more money. Is this an accumulation cylinder? 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. And then this just rips to the upside in this fashion. It could be. And I know that sounds really weird for a lot of people. A lot of people think that we're in some big bust phase of real estate, but it's the weirdest bust phase that I've ever seen that doesn't have any inventory. So is this potentially a Livermore accumulation cylinder occurring in the banking ETF KRE? I don't know. I'm not going to buy KRE, but there's other ways to play this. Commodities are going to be the leverage play to play it. If this is the case, we should also see home builders be quite resilient at this time. So if I were to pull up like Lennar Corp, which is a very large home builder, what do we see here? That looks pretty dang bullish to me. It's a big move up. This is its consolidation here. 1, 2, 3. This is your 1, your 2, your 3. It breaks out of its all-time highs, does a retest, and we're sitting on top of everything. Now, this could easily pull back. I get it. I don't know the path, but right, wrong, or indifferent, this thing looks absolutely bullish for a large thing. The other company, that's D.R. Horton. D.R. Horton's another large corporation. You can see this thing is also coming up, and people are going to say, well, that's a rising wedge. Yes, I would also kind of draw it like this, perhaps, because your consolidation of a real estate market it's 1 here, comes back, comes up. This is your 2, and this is your 3. It broke out, did a retest, just like Lennar Corp and all the others, and we're going to hopefully come on up. But we could slow down like this and do another retest. Totally possible. But to me, the cycle looks very strong for home builders. And there's a whole bunch of other home builders that I could pull up as further evidence for strong home builder charts and activities. So let's just piece this together here. All right, let's just piece it together. We do have an inverted yield curve. It could drop, and we could get a slowdown in the market. Okay, it's not from the real estate market. The slowdown is not necessarily from the real estate market. How do I know that? We don't have any inventory. We're not in a hyper supply phase. And all the home builders are sitting on top of their patterns. They're not breaking down, blowing up patterns. What happened last time is this fell because we were in a hyper supply phase. We had tons of inventory and we overbuilt. We do not have tons of inventory and we have not overbuilt, which means we are still early in this commodity bull market because that is the driver of the inflation, one of the drivers. The other driver could be a credit problem, debt problem, stuff like that. I know some people think they are convinced, they just know to their core that this housing market is a bubble. I'm here to tell you, to me, doesn't look that way. Doesn't look that way. Why? Why the heck are you sitting on top of patterns if this was a bubble? So if this was a bubble here, guys, all the home builders turned down in 05. They all turned lower in 05. This was a high. This was a lower high. We came all the way down in 05. Lennar Corp was the same way. Lennar Corp in 05 came back down. Here's your bull trap, and then we came back lower. But what do we have here? We have, it could be maybe a double top, potentially, and we do come on back, and then we go back on higher. Why? The homes are not built, guys. We have a large demographic, and I know people are going to say stuff about baby boomers dying off and stuff like that. I don't believe it. I don't believe it. I think the demographics larger than the baby boomers. We are still short probably 5, 6, 7 million homes. And we should see it if they overbuild in inventory. We just don't. And why am I talking about this so much? Because that's what drives the cycle. Everything else doesn't matter. That drives the cycle, at least historically. So if we do have this strength and all this data here, as I go over it, Strength in the home builders. We have no inventory. We're not in a hyper supply phase. Check, 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 check. The yield curve's inverted, so we could have a slowdown like the 2000s, like the 2000, 2001 pullback, where interest rates go up and it cleanses some stuff out of the system. Talked about that before. But that's not the driver of commodity bull market. That's just a slowdown in the market. That's in the middle of a big secular bull market of commodities. Another thing we could look at is we could look at the ratio of, let me see if this is it. Not here, this is another ratio that's supporting evidence. This is the producer price index to consumer price index. This is throwing in a double bottom and a potential move up when this starts to come back, when inflation comes back, when loading comes back. And if that Livermore accumulation cylinder in the regional banks goes up, then your producer price index is going to go up because that's going to be the driver of inflation, your producer price index. This is signaling a double bottom where a producer price index is going to outperform the consumer price index, which means a very inflationary force is going to be coming if we break completely out of this pattern here. If we break these resistance levels, this one here and this one here, we are going to a place that is unrecognizable, like massive inflation. And that is something we should be watching. So again, when I look at the markets, I just stack all this information up. I stack it all up. The regional banking looked like a Livermore accumulation cylinder. Home builders on top of their patterns of very long, big-term patterns. And we're entering an expansion phase of real estate. We haven't built the homes. We're not in a hyper supply phase. We don't have a lot of inventory. Portability is bad. I get it. Could we get a slowdown in the market with the yield curve inverted? Yes. But the 2-year yield's not dropping and the 10-year yield's not dropping. That means that banks and other investors are not running into those assets, signaling that a potential slowdown could potentially come. So where are we in the cycle? That's the difficult part. Every single one of those times beforehand, 2-year, 10-year drop before those slowdowns in the market. We don't have a 2 and a 10-year dropping yet. It's not there yet. Which means, could we still go higher? Are we going to get a recession? Is the recession behind us? Has it not come yet? Like, I don't know those answers. That's what we're going to have to wait and see and look at the data. But everything that I look at, it still looks very well positioned for this to occur. Then it's just the timing. Could we get a slowdown before the ultimate big move? Possible. But I don't see it in the 2-year and 10-year going down. So that's the data that I'm looking at. Unemployment, we can also look at unemployment. We can look at construction employment and all that stuff. That's generally where a lot of these recessions come from. So total construction spending is still going up in terms of total construction spending on residential. You look at U.S. construction in terms of all employees. This was your big move lower before the recession, which happened in 2007. Your yield curve inverted. It started to uninvert. People piled into bonds. And then we saw the all employees construction fall off a cliff. This was 1990. This was another housing market boom bust cycle. This was a bust in 1990. We overbuilt. This year is the 2000 mix. It came down a little bit, but it wasn't a crash necessarily from this market. So it impacted the housing market, but it wasn't the ultimate reason of the bust. Here you can see there's a blip in 2020, but we are still looking pretty strong and we haven't rolled over and started to go lower. So this crash isn't being driven by the construction cycle. It's still looking good. Here's total construction in terms of spending, which is continuing to go up. Hasn't turned over. So a lot of the data that I look at, it hasn't turned over, at least not yet. I'm looking for, I'm going to do another one here. This is the producer price index divided by the S&P 500. Let's do it the other way around. Let's put the S&P 500 first, divided by that. So these are your commodity bull markets here, where the producer price index outperforms the SPX. I think if you can tell, I think that's going to occur again here. We are starting to slow down. This could be, oops, this is your high and this is a lower high. And then we could probably come on lower, which means that the S&P 500 is going to start to underperform the producer price index. That also jives with the producer price index divided by the consumer price index, which I just showed you. So these are commodity bull markets here. And I think we just started one. So everything that I look at is supportive. The evidence is supportive of a commodity bull market, and that we're still in it. And I just don't see the data yet for a potential slowdown that a lot of people are calling for. And maybe it comes, maybe it doesn't. We'll see. But that's what I wanted to cover today. Hopefully this kind of helps you figure out where we're at in the cycle. What that means is we've got the big inflationary surge that's kind of behind us. We could get another wave of inflation. Some of this was controlled by the dumping of strategic petroleum reserve barrels onto the market. Some of this stuff was kind of controlled, so we don't know necessarily if this is done yet. I don't think Powell knows if it's done yet or not. And higher for longer could definitely mean a lot higher than what most people think. Some are saying that we are going way higher in interest rates, which means this is not done yet. Others think that the yield curve's inverting and it's uninverting and that we're going to get a recession. Who's right? I don't know. I don't know who's right. We're going to have to continue to see how the data plays out. All right, guys, that's what I got for today. Thumb up. Subscribe to the channel. If this interests you guys, sign up to the website. We do have a discount going on. Spooky is the discount. Check out in the description link the discounts that you guys get. But that's what I've got, guys. We'll catch you next time. This is Finding Value.